Hola mi gente, welcome back to the channel. My name is Sean and this is We Are Investing. On this video, we are going to be talking about what is a stock split and how can it impact the price of a stock moving forward. Does a stock split have any impact on your investment? Are there good ways to trade stock splits? Those are the kind of topics that we're going to be discussing on today's video. Now, if you're new to this channel, my name is Sean and this is We Investing, and please consider joining the community by hitting that subscribe button, ringing that bell, and smashing that like button to help with the YouTube algorithm. This is a community where we learn together, grow together, and make money together. And if you like making money and you want to be part of this community, then definitely consider hitting that subscribe button. Now, to get started, we're going to discuss what is a conventional stock split. Then we'll dive into what a reverse split is as well. So a conventional stock split is when you increase the shares outstanding, and as a result, you are going to decrease the share price, the amount that you pay per share. But the overall valuation of the company is going to remain unchanged. The best way that I can explain it to you is, let's say a company wants to go public. Let's say that this notepad represents a company, and the company is Michael Scott Paper Company. So let's say Michael Scott is looking to take his company public, and based on the assets that he has, the free cash flow, the revenue growth, the projections, the bank, let's say the Bank of Scranton, is willing to underwrite this company for $100. That's what the company is worth. So Michael Scott agrees, and he's going to do a traditional IPO and take his company public. As a result, he is going to get $100 by doing so. But in order to get that money, he needs to create shares. So let's say we're going to separate this paper, and now this paper, which represents Michael Scott Paper Company, is going public through a traditional IPO. Now, it's $100 for total valuation, but let's just make it real simple and say that there's going to be 4 shares outstanding. So we're going to rip this paper into 4 little pieces. Now that we have 4 pieces and each piece of paper represents a share, let's say Michael Scott is going to keep 2 shares. So he's going to hold 50% of the company. Each share allows Michael Scott to vote and basically dictate and run the company. Because he owns 50% of the company, he is the majority shareholder and he controls what happens. This is like Jeff Bezos of Amazon or Elon Musk of Tesla. They own the most amount of shares. So I'm Michael Scott in this scenario, and I'm going to put these shares in my pocket. There are still 2 shares out there that need to go to someone. You're going to get 1 share, and the person over, I don't know where, in California is going to get another share. But there are 4 shares out in the market. I own 2, you own 1, and somebody else owns 1. The 4 shares out in the market, this is the shares outstanding. And because the company was valued at $100, these are valued at $25 each. Now, somebody might be willing to pay you more for this share because they think that I'm doing a great job at my paper company. It's going to be worth more in the future. So potentially, this $25 share could be worth $30 in the future if somebody's willing to pay for that. But what is a stock split? Well, let's fast forward a couple years and let's say that we are just killing it right now in this business and we basically have a monopoly. We're making money hand over fist. Instead of the company being worth $100, let's say it's worth $1 million right now. So every single piece of paper would be worth $250,000. It's going to be very hard to find someone that will buy 1 share worth $250,000. So what we can do instead is say, all right, it's time to do a stock split. Instead of having 4 shares outstanding, let's cut this up into smaller pieces and make it more affordable for your retail investor. Now, I did a bad job by picking $1 million and $250,000 per share, but let's say that for every share that you own, we are going to do a 4-to-1 stock split. So now, instead of owning 1 share worth $250,000, you own 4 shares. The amount that you own of the overall company has not changed, but each share is now worth less. So in this scenario, instead of owning one share worth $250,000, now you own now you own 4 shares, and each share is worth $62,500. You might be able to find a buyer at a more reasonable timeline with a sell price of $62,500 instead of $250,000. But the overall value of the company remains unchanged. We're still worth $1,000,000 altogether. My holdings still make up 50% of the company, and your holdings, if you did not sell any, still make up 25% of the company. That is a traditional stock split. A reverse split is basically the same thing in reverse. Let's say that you own 10 shares of a company. We can do a reverse split and convert those 10 shares into 1 share. This happens a lot when the stock is at a very low price, typically under $1, to remain in compliance, because typically stocks need to be trading at over $1. So you'll see a lot of penny stocks do reverse splits just so they do not get delisted. So if the stock's trading at 50 cents, they can do a reverse split 4-to-1, and then that stock would be trading at $2 a share. Reverse splits, you're probably not going to deal with too much unless you are really dealing with penny stocks. Conventional splits are very common, especially with very solid companies that have really good performance, because eventually stocks are just going to continue to go up, and they're going to reach a point where they become unaffordable for retail investors. So that essentially is what a stock split is. But why do stocks split? Well, there are a couple main factors. The first one is perception. There is a perception that when a stock is trading at a couple $1,000s per share, that it's very, very expensive. But like we said in our example, it does nothing to the valuation, the overall value of the company when a company does a stock split. But it's perceived to be cheaper by retail investors when a share price is lower. It also makes it way easier for retail investors to buy. Even though fractional shares are available, they're not available on all brokerages, and not everyone likes doing fractional shares. So when a company's trading at $2,000, for someone to buy a stock worth $2,000, that might make up a very large portion of their portfolio and make them too concentrated in one particular stock, and it makes it very hard to dollar cost average, meaning that when the stock drops, it's hard to buy more of it because it costs so much money and is such a large percentage of your portfolio. It's much easier to dollar cost average when a stock is $50 a share, $100 a share. You can buy a couple stocks every month, every week, depending on how much money you have in your portfolio. Another big reason why stocks split is because of the options trading market. The options trading market is a huge part of the stock market. Trading derivatives is used by so many people, and it plays such a big part, and it can have a huge impact on pricing and sentiment as well, and can introduce different types of traders and investors into a stock. The options trading market deals with options, which are contracts that give you the right but not the obligation to either buy or sell 100 shares at a certain price. The higher the stock price is, if it's $1,000, well, to buy 100 shares at $1,000, you're talking about $100,000. And that is why when share prices are high, it's very hard to trade options for those particular stocks. And it prevents a lot of options traders like myself from investing in those companies, because I personally love using options to create as a vehicle to improve my investment. So for example, when Google is going to do their stock split and when Amazon is going to do their stock split, both of those stocks are worth a couple $1,000s per share. When they do their stock split, they're only going to be worth a couple hundred instead. And that makes it way easier to trade options and allow someone with the portfolio of my size to actually buy and sell calls and puts. Another big thing when stocks do splits is liquidity. Liquidity is how many shares are traded in a given day and how easy it is for you to either buy a share or sell a share. The lower the share price is and the more shares outstanding there are, the easier it is to buy and sell a stock, making it way easier to trade. You don't have to worry about finding a buyer or finding a seller to buy a stock from. When the shares outstanding increases and the share price is lower, liquidity is so much better. Now, the last reason why stocks do splits, especially big companies, is because of a major index, the Dow Jones Industrial Average, which is a price weighted index. Every stock that is in the Dow Jones, the weighting that they have on the index is based on the share price. It's not based on market cap like the S&P 500. So as the share price increases for a particular stock, the weighting in the Dow Jones increases as well. So if a company like Amazon trading at $3,000 a share, wherever it's trading at right now, was to be in the Dow Jones Industrial Average, it would make up a huge weighting. And then that index would be too concentrated in a particular name. When stocks do splits, then they can be introduced into the Dow Jones without negatively impacting that index or having too much of a weight on the Dow Jones Industrial Average. Now, like I said, a stock split as an investor doesn't really have any impact on valuation, so it shouldn't really concern you. It just makes it easier to invest. And because of the market that we currently live in, and with fractional shares being available on a brokerage like Webull, which if you use my link down below, you can get worth up to $9,000 in free stocks through that exclusive referral link down below. Webull offers fractional shares, so you don't have to wait for a company to do a stock split in order to invest in them. And sometimes waiting is not the right approach either. So if there's a company that you like, but the share price is just too expensive, not based off of valuation, just based off a dollar amount, then maybe it's worthwhile to buy fractional shares and continue to dollar cost average through fractional shares. The reason why I say that is because performance for a lot of stocks post stock split is actually negative. And that's going to bring us to the next part of this video. We're going to take a look at performance of stocks after they split. So here we go. This is based off of 240 stock splits. And we can take a look at the 2-week return. The average is negative 0.06% after the stock split. This doesn't include the run up that you typically see before the split. That negative return 2 weeks after is typically because traders are buying the rumor and sell the news. 1 month you're at 0.17%, 3 months you're at 1.5%, 6 months you're at 5.25%, and a year out you're an investor and it shouldn't impact because it has no impact on valuation. If we compare that to the S&P 500, you can see that the 2-week return on the S&P 500, the average return is positive at 0.25%. The 1-month return is also better at 0.47%. The 3-month return isn't as good. It's 1.44%. What does that show us? Well, there is a potential buy the dip opportunity after the split is announced and there is a sell-off. And if you hold through that in 3 months, you might make more money than the average, than the S&P 500. And if you look at the 6-month return at 5.25% compared to the S&P 500 at 4.39%, you're outperforming. So yet again, potential buy the dip opportunity, but right after the split, 2 weeks and 1 month, you're typically underperforming the index. Now, layering on sentiment, and I thought this was really cool. There's positive sentiment and negative sentiment. And you would think if there's positive sentiment, the stock is going to outperform. People are bullish on a stock, it should outperform. Well, actually, the opposite occurs. When there's negative sentiment, good news can be good news, and there could be reasons for the stock to move up if you get any kind of good news. So, with the stock returns after a split for positive sentiment, here are your average returns. 0.72% for 2 weeks, 0.27% for 1 month, 1.43% for 3 months, and 4.7% for 6 months. For negative sentiment, you're looking at 0.73% for 2 weeks, which is right in line with positive sentiment. But here is where you start to see more returns on negative sentiment stocks. 1 month, 0.27 versus 1.5, 1.43% versus 4.17, 4.7% versus 10.10%. So when there's negative sentiment, when there's negative sentiment, that actually might be a opportunity to buy a stock and could be bullish for you, as confusing as that might sound. So there you have it. If you're interested in investing in Google or Amazon or any company after they do a stock split, based on the data, it's typically best to wait for traders to get out of this trade. Wait for the stock split to actually happen and wait for a pullback in the stock. Based on the data, that seems to be the best approach. And that pullback is a buying opportunity, because if you wait 3 months to 6 months out, and a year even better, you can typically outperform the S&P 500. Now, Amazon and Google both have bullish sentiment. But if you find a stock that has negative sentiment after a stock split, those are typically your better opportunities based on the data that we saw. And like I said earlier in this video, you can trade the stock leading up to the stock split, but based on the data, there is typically a sell-off, so I would not hold through the event, at least not me personally. Now that wraps it up for this video. If you liked it, please consider hitting that subscribe button, ringing that bell, and smashing that like button. Let me know your thoughts down below. Are you going to be buying Amazon or Google pre-split, post-split, or during the split? Let me know what your plans are, or are you not going to buy them at all? Just let me know what you're doing down below in the comment section. It helps drive engagement, it helps with the YouTube algorithm, and I love hearing from you all as well. In addition to that, if you want to join the community, you can do so by joining the private Discord server, by joining the Patreon. A link is provided down below. Outside of that, I thank you so much for your time. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.